Hey there. The weekends are wild right now, aren't they? And before you even go there, I'm not talking about what you got up to last Saturday night. That's your own business. I'm talking world events, political instability, business risk. It's like you clock off on a Friday and you go back online on a Monday morning to a whole different world. The first weekend of this year, we had the US remove Venezuelan President Nicolas Maduro. The second, we had a criminal probe launched into Fed Chair Jerome Powell. And last weekend, President Trump threatened European countries with tariffs if he doesn't get his wish to acquire Greenland. The geopolitical risk is off the charts. So how do you navigate it all as an investor? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. This week's show, geopolitical risk. Okay, so what do you do when the US president is tearing up the rulebook on trade and international relations and you've got money on the line? If you're an institutional investor, you call up your geopolitical person. And that's what we're doing today. I'm speaking to Marko Papic. He's a macro and geopolitical expert at BCA Research, a global investment research firm. Marko, how are you?
Doing great, Carmel. Thank you so much for having me on.
Great to have you on the show. I noticed when I was doing a bit of research that you started doing a week ahead video on a Friday, like what to look out for in the week ahead. How's that working out for you?
It's not great because things are moving so fast that by the time I publish it on LinkedIn and X,
Yeah.
there's like 7 other things that I should have probably included. And I try to keep it to only 3 items
Yeah.
per Friday afternoon.
It's tough trying to predict, right? Can you explain to folks actually what exactly it is that you do? Because there is an element of prediction about it, right?
Yeah, for sure. I mean, I would not call myself a geopolitical forecaster or geopolitical
Okay.
strategist. I think that in today's world, the geopolitics and politics is as important to investing as really any other tool or framework. And so I consider myself an investment strategist who has a methodological bias to focusing on politics and geopolitics. And so I blend
Mm-hmm.
macroeconomics, geopolitics, and politics in order to gauge the performance of assets over the short term and the long term.
Okay. And how does that work in the Trump era?
It works great. First and foremost, in order for you to add value to the investment process, there has to be geopolitical volatility. So something has to be happening on the political and geopolitical front. That's obviously the case. The second is that you have to have a framework of how you go about doing this, something to hold on to, at the beginning of the process. And for me, that's focusing on the material constraints to policymaker actions, not their preferences. So most of my clients, they ask the question of what does President Trump want to do? I think that's the wrong question. I
Right.
think the right question is like, well, what can he do given the array of material constraints that even the President of the United States of America is subjected to?
I mean, but do markets care about geopolitical risk? And I don't mean to be glib asking this question, but it does seem, certainly like last year, there was a lot of uncertainty going on, but it was risk on the whole way. Like it was like markets were ignoring geopolitical risks.
Right, and that's your job to forecast. So your job is not to walk into the office of your client and tell them that you matter.
Right.
9 out of 10 times you don't, and you need to have the wherewithal and the understanding of how to blend macro with geopolitics to be able to tell your client, like, relax, Israel and Iran can lob missiles at each other, and it's not going to matter. In 2005, if Israel attacked Iran, oil prices go to $300. Well, we're not in 2005. We're in 2026, and the threshold for the market to care is different. And so I would put it the opposite way. I don't think that it means geopolitics doesn't matter. It just means that you have to pick and choose your battles when the alpha will be generated due to geopolitics.
And why is that threshold higher? Like, I've seen some commentators say, look, markets aren't reacting the way they used to geopolitical shocks. Like they're treating them like noise. Is that the case?
I think that in some ways, yes. Fundamentally, markets are still trying to assess, earnings of corporates.
Mm-hmm.
They're trying to assess, like long-term inflation and growth expectations. All of this is embedded, and there's different time horizons. And so I think that, a great example of this is when Russia invaded Ukraine. Oil prices went through the roof.
Hmm.
One of the instincts was like, well, this is the third largest exporter of crude invading a neighbor. Obviously, something's going to happen. But the other things that were going on in that moment were quite bearish for oil. China was in the midst of its zero COVID policy. And so China experienced a significant growth decline. And so the macro context still matters. And I think this is where most investors who are tourists in geopolitics make a really bad mistake. They see something geopolitical happen and want to bet on it. And then they throw out the window everything else that still underpins markets. And so I think that's the critical component here.
Right. So it's the macro impact that matters less than the actual geopolitical event. In other words, does it have an impact on economic growth? Does it have an impact
Yes.
on the price of oil? That's what really matters.
I think you have to blend the two, and you have to pick and choose, again, the battles that you want to fight. And trying to forecast geopolitical events, in my view, is very difficult. It's a losing game. It's after they occur that the
Hmm.
dislocation in the markets occurs, and then you can bet against that hysteria or that euphoria, whichever way it goes, focusing on the fundamentals. A geopolitical event causes dislocations, but the macro fundamentals are still set by the preceding decade or half a decade worth of decisions made by policymakers. The next 5 years or the next 10 years are about the geopolitics today. And that's where some of the assets are reacting to that longer term structure. I like almost more investing on that horizon because I do think you see dislocations today that are leading to asset prices moving. Gold is an obvious example. It's been going on for
Hmm.
2 years. But also now some industrial metals are catching up, commodities in general. The world of empires is one where we take supply of commodities off the global marketplace that by definition creates scarcity. So that's an example of a long-term trend that is underpinned by geopolitics and almost nothing else. The other one would be, for example, American assets, US dollar in particular. And I think there's more downside to that. That is also a way to play geopolitics that is not about the next invasion, the next war, the next rocket barrage from one country to another.
I mean, last year, Marco, it worked out well for investors ignoring geopolitical risks, right? Like equity markets hit record highs. Is this year going to be different, do you think?
No, I think the equity markets are going to climb the wall of worry. But in the short term, I do think that some of the geopolitical issues or political issues, however you want to, define them, are
Hmm.
in the very short term, imminently relevant. For example, the Supreme Court decision, President Trump's tariffs, puts at risk a considerable amount of revenue that did smooth and soothe some of the questions that the bond market was asking at the end of 2024 or in early 2025. So there are a lot of issues that are front loaded at the beginning of this year. There's Greenland, there's Iran, that I do think will weigh on risk sentiment, starting with the Supreme Court decision. But I think over the course of 2026, I think it's pretty evident what the Trump administration wants to do, and it wants to stimulate the economy through the housing market. So I think it would be dangerous to get overly sensitive to geopolitical risks this year.
Okay, quiz time. The global economy is super interconnected, even among rivals. The US and China, for instance, traded nearly $660 billion worth of goods and services between each other in 2024. But it wasn't always that way. During the Cold War, the United States and the Soviet Union barely traded at all. So what was their total trade flow in dollar terms at its peak in 1979? Was it A, $250 million, B, $4.5 billion, or C, $27 billion? I'll have the answer for you at the end of the show. Up next, we look at the Greenland thread. You mentioned Greenland, and we're recording this on a Monday with the turmoil over Greenland still very much, churning away. And we are seeing, a reaction on stock markets. They're falling on those tensions. Do you think that's the right call then, or do you think that's just like a knee-jerk reaction? That's just
Yeah, I think it's a knee-jerk reaction. I think President Trump is, again, it is Monday, the 19th of January. So I don't know what's going to happen with the Supreme Court decision.
right.
But the consensus appears the Supreme Court will rule against the tariffs. And I think that President Trump is both distracting from that with the Greenland saga, appropriate
Okay.
use of saga. But the
Yeah.
other one, the other one is that he also then has a technical reason with which to impose more tariffs in case those tariffs are taken away violently by the Supreme Court. So that's something that a lot of investors have not considered. Greenland, this perceived national security risk of not owning Greenland, gives the president the prerogative to impose tariffs on Europe. And that's important if the Supreme Court takes those tariffs away. That's one of the reasons that this entire green saga is very useful for the administration. But we've seen a very, very vociferous attack on president's position by his own Republican allies in the Senate. You know, senators like John Kennedy or Tom Tillis. This is not something that happened with the Liberation Day on April 2nd of last year. So there's actually far greater resistance to President Trump on Greenland domestically than there was on tariffs. And so I don't actually take the risk that seriously.
But even if it did escalate, I mean, does it matter that the US, kind of Europe, the transatlantic alliance is in tatters? Like, should markets be worried about that?
You know, so that's an interesting question. I mean, yes, of course it should matter. This is the bedrock of Western stability. But like, what do you buy? What do you sell? You
Hmm.
know, I'm not here to talk about geopolitics. I'm here to talk about geopolitics as a tool of investing.
Right.
Like, that's the only thing I do. And the reason I say that is because, like, I want to load up on European assets. This is the best thing that's ever happened to Europe in
Well,
many
that's what I
ways.
was going to ask you. So what are you advising? What are you telling your investors right now, right, given everything that's happening in Greenland?
Look, if there's a break between Europe and the US, the first thing we have to consider is that the United States of America has one of the deepest net international investment position, most negative in the
Hmm.
world.
Right.
And the US finances that through, you know, the fact that it has a capital account surplus because of its deep current account deficit. What that means is that folks out there sell stuff to America and they get dollars for it. And
Yeah.
then they buy American assets. And
Hmm.
Europeans own, between Norway and the rest of the EU member states, like you're talking about $2 trillion worth of US assets that could be dumped if America just decides to invade one of its closest allies ever. And by the way, Denmark is not just a NATO member states. There's
Hmm.
NATO member states are not all created equal. Some are more enthusiastic about their alliance with America, and some are less. Denmark is the most enthusiastic by far. So this would be a really significant sort of shot across the bow of all foreign investors in American assets. American assets are already on shaky ground. Why? Because they're extremely expensive. And because the US administration has, in many ways correctly, identified its deep current account deficit as something that should be fixed. That in of itself should cause the dollar to be flat to down over the next 5 years. If it then also wrestles a piece of sovereign territory from one of its allies, I mean, it's going to be a deluge. So I would want to load up on European assets if America does invade Greenland, both because of that technical issue, but also because Europe will then have a clear geopolitical imperative to further integrate and to further consolidate, whether it's on fiscal policy, investment, single market, defense. You know, they're going to stimulate out of this way. That's the way you solve it. Whereas for America, it's not really a big value add. I'm not going to be owning American stocks or
Hmm.
assets or dollars because they have rare earth minerals buried under 30 meters of ice.
I mean, the market itself, though, does it kind of in a way sort of put manners on things in terms of geopolitical shocks, in the sense that, like, you know, earlier, like last year, we saw that Trump pull back from some of his stiffest tariff threats when we saw that kind of quite violent reaction to the April 2nd announcement. So does the market itself, in a way, contain some of the geopolitical risk?
That is in of itself my framework, right? So when I say that I focus on material constraints, what are
Hmm.
material constraints? Well, there's a plethora of them. They can be, can you invade this country? Do you have the military to do so? Like, I don't care if the leader of the country wants to do it. Can you do it? But also bond yields. Bond yields are a material constraint. And one of the things that we noticed is that at the height of the Liberation Day hysteria, bond
Hmm.
yields went up, which was a curious reaction of the bond market. I mean, US bonds are supposed to be a safe haven, number one. Number
Hmm.
two, egregious high levels of tariffs are supposed to actually be disinflationary because they end economic activity. Bonds should have rallied, they didn't.
Hmm.
And so, yes, that was a signal from the bond market to the Trump administration that, for a slew of reasons we don't have to really go into because it's backwards looking, but it did not appreciate those levels of tariffs. And so you're absolutely right. This is something that, investors have known for a very long time. There's a reflexive relationship between markets and reality. And markets in of themselves are part of that, array of material constraints that policymakers have to navigate. That's why I don't care what President Trump wants. That is not the question we should be focusing on. It's how he will navigate this array of constraints.
But for clients who are looking to hedge a little bit, to go a little bit risk off, who are worried about what's happening, what do you advise them to do? Like, we talk about safe havens all the time. Is that just precious metals? Is that just gold and silver? Because they look to be, they're up a lot.
They are up a lot. I completely agree. And I think just in general, commodities are going to have a very, very good run. They've already had a great run since 2022. In a world of multipolarity, where countries are actively in the process of taking resources off of the global marketplace, which is what Venezuela really was about.
Mm-hmm.
President Trump is being very honest, very direct when he says, like, we did this for the oil. And so the reason that's so important is because President Trump says, like, look, this piece of real estate that has some oil barrels, we're going to take that. And what that sets off for the next 5 to 10 years is effectively a race to sequester global supply of commodities off of the global marketplace, which will take supply off the market. Now, you could argue China's been doing that for 20 years by buying industrial metals and then storing them, but that's different. What China does with copper it buys on the open market is up to China. I mean, if he wants to bury it underground, God bless him. That copper was available for everyone else to buy before it was bought by China. What America is saying, like, you won't even have the opportunity to buy this oil. We're going to take it.
The energy price is interesting, though, isn't it? Is that one of the things that, in a way, the fact that there's so much supply out there, that the price of oil is, historically it's at moderate levels, is that one of the things that actually keeps those geopolitical risks from frightening investors, frightening markets, because there's just this ample supply of oil?
I mean, in part, yes, but I think that we should understand why oil markets are well supplied. And it's because Saudi Arabia has been fighting a market share war and has keeping OPEC production high. But there's also an issue where Saudi Arabia has been trying to create a macro context that's positive for President Trump, namely on inflation. I think at some point, Saudi Arabia is going to have to start thinking about its own interests. And if you look at Saudi macro context, current account deficit is deepening. They have to dip into currency reserves. They have a very ambitious agenda to industrialize the economy and diversify it away from oil, but that requires oil revenue. And so I don't think that the current oversupplied markets can last forever, because I do think at some point Riyadh is going to tell Washington, D.C., like, look, we did our part. We kept oil prices low for 12, 16, 18 months. It's our turn now to focus on ourselves. And so I would be very, very careful in expecting this globally oversupplied markets to continue forever. I do think that OPEC will have to cut production over the next, 6 to 18 months. I can't time it. I don't know when it happens, but at some point, maybe the day after the midterms in the US, I don't know when, but I do think that the current level of oil prices is too low for Saudi domestic priorities.
Do you think we're going to see a big ramp up in Venezuelan production? Do you buy into Trump's argument on that?
Oil reserves are to countries' oil production as horsepower is to quality of the car. It means nothing. It is a vacuous data point. I think President Trump knows I'm right on Saudi reaction function. I think he knows that his good friend, Crown Prince Mohammed bin Salman, cannot keep delivering $50 oil to him forever. And I think the Venezuela thing was an attempt by President Trump to illustrate to the American public that even if oil prices go from $50 to $70, he is doing something to eventually bring those oil prices down. But I think the chance of us getting more oil out of Venezuela in a meaningful way over the next 2 years to make any difference to global prices is near zero.
If money and finance is your thing, we've got you covered. Our brand new sister pod, Reuters Morning Bid, is your go-to market briefing 7 days a week. All you need to do is go to your favourite podcast player or ask your smart speaker for Reuters Morning Bid. to get that market edge straight from the experts in our newsroom. And if you'd rather watch along, we've got a video version for you too. In the final part of the show, we look at the sort of shields investors can deploy against geopolitical risk. For 2026, is it going to be a similar story to 2025 in the sense that the AI boom trumps everything? Is that what investors are going to be? Is that what's going to be driving flows? What's going to be driving markets?
I think that, first of all, let's think about 2025. I think you and I would both agree that AI did drive a lot of things. But notice that European equities absolutely crushed American equities. When you add currency performance, I mean, it's one of the most epic divergences. So what's curious to me is that even in 2025, which we would both agree was AI-led, American assets already underperformed. I mean, for 12 months. So I think going forward, I think the AI capex boom continues in the US. It's just that there's no way that the AI capex story can have a better year than 25. In rate of change terms, it's just very difficult for capex to drive American growth. 68% of American economy is consumption, household consumption. It's not capex. And so I think that you will continue to see AI-related plays do all right. It's just that if they couldn't beat Europe, China, and emerging markets in Japan in 2025, when are they going to do it? I think the US is likely to go back to outperforming the rest of the world in the 2030s. But in order for it to do that, valuations have to come down, US dollar has to come down, and portfolios have to rebalance first away from the US.
And for you, in terms of like the big risks this year, what are the things that worry you?
Well, the number one thing that worries me is that US economy, what President Trump is doing and what Treasury Secretary Bessent are doing, they're trying to incentivize American households to borrow. That's why the announcement of $200 billion worth of mortgage-backed security buying by Freddie and Fannie, that's the most important macro event of this year. It's not Greenland, it's not this or that. It is the fact that American policymakers are trying to juice up the housing market. I think they'll be successful. However, the number one risk to this is if long-term borrowing rates go egregiously higher. That to me is the biggest risk. And that's why the Supreme Court decision is so important. It's so important for us to read what Supreme Court says. If they rule in favor of the tariffs, we're fine. We've got locked up revenue for next decade. The bond market will cheer that. If the Supreme Court says, well, you can't use AIPA, you got to use some other legislative act, that's all right too, because there's many other legislative acts that President Trump can use. But if it says something more dramatic, sort of like, well, look, it seems to us like you're raising revenue. You need to do that through Congress, then we've got a problem. And then bond market may react quite negatively. Or if President Trump goes too hard on the Fed, as he clearly has already, all of these unorthodox policies could cause borrowing rates to not cooperate with the mission objective that Trump and Bessent have laid out, which is lower borrowing costs. So that to me is the biggest risk. It's not Greenland. It's not, Russia, Ukraine. I think it's domestic politics effectively in the US is the biggest risk.
When you mentioned there the Supreme Court decision, I actually thought you were talking about like the Lisa Cook case. Would that not be potentially, if they were to rule in favor of the Trump administration there, would that potentially be a bigger threat to long-term borrowing costs?
Yeah, absolutely. I think you're right. Thank you for bringing that up. I mean, yeah, I wasn't talking about that. I was talking about Supreme Court on tariffs, just because tariffs bring in so much revenue, but that can be put into the same bucket. It's okay for the Supreme Court to say that Trump can fire Cook. That's okay. The question then is, what does he do with that power? And so those are some of the issues that I'm watching. Obviously, as a geopolitical strategist, as someone who tries to invest based on geopolitics, I'm always looking for China-Taiwan tensions as well. That's always on the back burner, of course. I just think that China has many reasons to delay reunification of Taiwan, aside from what the US is doing. And so I don't think that's imminent. I don't think that's what 2026 is going to be about. I think 2026 is going to really be about, can President Trump be orthodox enough in order to effectuate the plan he just laid out to us, which is that I will get Americans to borrow, buy homes, dip into home equity lines of credit. Like, I will do that. Well, prove it then. To prove it, you need to be orthodox. You need to bring borrowing rates down. Anything that causes bond yields to go higher will interrupt this very sanguine story of household releveraging. And that's why the midterms, ironically, paradoxically, losing them may be the best thing for President Trump. Because at that point, his populist instincts will die in the House of Representatives, where the Democrats will simply say no. And that will absolutely calm the bond market. A split government would be a great boon for President Trump and also, I think, for US markets.
Marko, thank you so much for your time.
Absolutely. It's a pleasure. Thank you.
A big thank you to Marko for his time and insights. You can catch all of our great economic coverage on Reuters.com and the Reuters app. Now for that quiz. I asked you, what was the total trade flow in dollar terms between the United States and the Soviet Union at its peak in 1979? Was it A, $250 million, B, $4.5 billion, or C, $27 billion? And the answer is B, $4.5 billion, driven largely by US grain exports to the USSR. The trade was part of a broader period of détente in the 1970s, where trade restrictions were relaxed to foster cooperation. But the Soviet invasion of Afghanistan in December 1979 led President Jimmy Carter to impose a grain embargo and restrict other exports to the USSR, effectively halting the growth in trade. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, just drop us a line in the comment section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Josh Summer and Sebastian Summer. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out Reuters World News Podcast. You can catch it on the Reuters app or wherever you listen to your podcast.